You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-interesting, ever-exciting Options Insider Radio Network. If you haven't tuned in to our latest editions, you're really missing out. Of course, Options Playbook Radio, for those of you who want a bit of a refresher on how these options things work, as well as some interesting ways to break them down using some sports metaphors and some sports analogies. Check it out, Options Playbook Radio. I think you're going to like it. And if you're one of the people out there who's been all up in arms lately about Michael Lewis's new book, Flash Boys, and about all the craziness with HFT, which we're going to get into a little bit later in this show as well, we have a great program for you. It's called Trading Tech Talk. It dives into all that stuff. HFT, the tech behind our trading, are your markets rigged? Will the technology fail and implode and come back to kill you? And all sorts of fun stuff. We hit on all those topics over there on Trading Tech Talk. You can find both of those, of course, wherever you find our Options Insider Radio Network programming, including iTunes, Stitcher, AHA Mobile, even now through Stitcher and a few others in that new Apple CarPlay, so you can get it up and running in your car. A lot of great places. And indeed, our Options Insider Radio Network mobile app, which you can find in the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store. Heck, now that they have the new Amazon device they just announced, you can listen to these shows pretty soon, I'm sure, on your Amazon Kindle Fire video streaming device as well. So a lot of great ways for you guys to check out our content. Check it out, the Options Insider Radio Network mobile app. I think you're going to like that as well. And joining me on the old Vol Views panel today, I have my two regulars, my two cohorts, my two partners in crime, starting out with the man beaming in from the heart of modern finance, known otherwise as rural Virginia, none other than Mr. Jared Woodard from Condor Options and Klineman Financial Group. Jared, welcome back to the program, sir.
Hey, thanks. I'm always happy to be with you.
You sound so positive and so enthusiastic. I like that, Jared. It's such a refreshing change from our other guest here, Mr. Andrew Giovinazzi, the Rock Lobster himself, who's always so confused and surprised to find himself on this program. Andrew, welcome back to the program to you as well, sir.
Where am I again? What are we doing? What is this? The fixed income show?
Yes.
Sold. I'm sorry. I was very confused because I live in a state of confusion. Too many options rot the mind. It is a pleasure to be here, as always, Mr. Longo.
Andrew, of course, coming off his big, successful hosting gig on the Option Block program, so I think he's going to let a little bit of that go to his head today. We'll make sure to keep him in check on the show today, Jared. Because once his ego gets going, there's no stopping the rock lobster. And without further ado, we're going to keep on rolling right on into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we break down the week that was, as well as the week that currently is right now from a volatility perspective. We are, of course, recording this, listeners, on Friday, April 4th, right around 2 p.m. Central Time, so we still have a few hours to go here in the old day. And it's been an interesting week. Well, I'd say the beginning of the week was a bit tepid from a vol perspective. We opened the week in looking at just the implied S&P vol perspective, VIX cash. We opened it right around the high 13 handle and kind of vacillated around that range for the bulk of the week. But then going into today, we had some interesting developments coming out of the non-farms, and that seemed to give the markets and volatility itself a bit of a boost. So perhaps we'll start there, Jared. Looking back on VIX over the past week, what really caught your eye, if anything, leading into the end of the week? And then what was your take on non-farms this week? And the traditional narrative for non-farms is that people keep their powder dry a little bit, or they even perhaps bid up that premium on Thursday night going into that number. Did we see that this week? And is that coming out as a result? Or what was your take on the buildup into non-farms as well?
Yeah, so one of the things we've been talking about this year has been the a little bit unusual relationship between changes in the S&P and changes in implied vol indexes and VIX futures and implied vol in general, where the market will rally and traders just haven't been selling, at least not on the future side of things, like we would normally expect to see. This week, I felt like, at least in the first half of the week or so, that really changed. You finally saw the front of the VIX curve start to steepen a bit. Traders were selling the near-term futures more. So a bit of normalization there, in my view. And then you even had selling Thursday, ahead of non-farm payrolls. I think the May and June VIX contracts were pushing to the lows for the week. And then, of course, today with the market selling off, you've had a big spike up across the board. Although, again, the first month or two, those contracts in the VIX are really just where they were, say on late Monday. So it's not like we kind of had a round trip, not too much damage done.
And Mr. Andrew, same question for you. What really caught your eye in the week that was from a VIX perspective?
VIX perspective, I don't disagree with Jared too much. We finally had some of the skew break down a little bit. Some of those out of the money puts and stuff started finally going away, at least declining somewhat from the highs they had. And I think that helped contribute to the cash drifting down, of course, at least till the end of the day. I don't know what button everybody hit here at about 10:30 or 11 a.m. Eastern time, but there was a little bit of a shift. What I am very curious, maybe we can talk about it later, but I am extremely surprised by the very low levels of vol and all the vol products. I think we're hitting 2-year lows. To me, I think that's a kind of a bullish thing as far as, if they're really not bidding for vol on the vol products, that's a huge sea change as far as, how the funds are looking at protection. I mean, nobody's buying, basically spending any money for protection, not buying puts, not buying calls, not buying anything in the vol product. So I find that a little curious at this level. I mean, I thought people would be jumping in at least a little bit to bid this stuff up, but, as of right now, they're not. So I find it, again, very interesting in my view. So.
And speaking of not bidding premium up, did you see that going into today's number as well? Was that pretty much the narrative throughout the entire week? Is that people weren't coming in and putting on a little bit of protection ahead of the non-farm? Non-farm has been a bit of a mixed bag over the past few months. In years past, non-farm was this great period of trepidation in the market. Everyone would kind of put on some protection, or at the very least, stop aggressively hitting bids in every options they possibly could going into the numbers. We've seen that kind of taper off a little bit over the past few numbers. Did we see that again this week, Andrew, or were people putting on a little bit of protection going into this morning?
Yeah, they actually sold the VIX futures down a little bit on the close yesterday. And and through the close, even in the after hours, just right after the 4 o'clock bell. So we're obviously above that level now. We opened lower this morning from a vol point of view, almost across the board. And that turned around actually pretty much about 20 minutes after the open. There were huge buyers. There were buyers of volatility right away. But at least as far as the number went, I think that is losing significance, we'll say, as a vol tradable event. I think it's kind of going away. This was like the second in a row. It was sort of ho-hum. It used to be much more interesting, but I think Yellen has let the cat out of the bag as far as the taper goes, and they're getting out of buying bonds, at least short term, and then we're on to when they're going to start raising rates. So that trade, I think, is gone away. But
yeah, that was kind of the big driver for non-farms, is to give you some sort of insight into what the Fed was going to do. You're right. Now that Yellen has kind of let the cat out of the bag a little bit, some of the luster has come off of the non-farms numbers. You know, you mentioned vol earlier, Andrew, and we talk vol. You go right to VXST. That's pretty much the encapsulated vol. I believe we've called it the gamma of VIX in the past here on this program, or the gamma of vol in general. We saw some interesting developments in that product. It was kind of a staid week for that product as well until today. We saw the VXST closing yesterday at about 12.5 and gapping up about $1 today off of today's sell-off post non-farms. Jared, I know you've been watching this for quite a bit. We've talked a bit in the past about how, for all the interest in this product, doesn't really seem to be driving a lot of volume in the futures. Everyone's still playing wait and see for the options. Is that still what you saw going into the non-farms this week? No one really lighting up the tape out here in VXST futures?
Yeah, not as far as I know. It looks like on the product side, people are still kind of taking a wait and see approach. And it's interesting. I mean, the action there has been kind of what you'd expect. Maybe not even as large as maybe some people had been looking for, but I think it's definitely a good insight at how low vol has been. Specifically, we're talking here, I think, about the implied vol in, say, VIX options, as opposed to the realized vol in these vol products, which still moves around quite a bit. And I think it's that change in the VIX option behavior that's so key. So VVIX is the index we all watch for that, right? And you had moves this week to, I guess, the lowest level since at least since mid-January. Bit of a spike up today, but still in the mid-70s. That's the area we'd typically regard as pretty moderate to low. So we got a 1% move lower in the markets on this Friday, and the response in VIX option land has been pretty muted.
Well, speaking of VIX futures volume, it's that time of the month where we get to look back on the month that was from a volatility volume perspective. And surprise, surprise, it was yet another banner month, and indeed a banner quarter for volatility products pretty much across the board. VIX futures volume rose 20% in March from this period in 2013. The ADV was a stunning 183,000 contracts. That's just mind-boggling. That's a 14% increase from March of 2013. A 15% decrease, though, I should keep in mind, because February was a pretty rocking month. A 15% decrease from the record ADV they set back in February. Overall, futures total volume for the VIX was about 3.86 million contracts. Again, a 20% increase from March of last year, and a 6% decrease, actually, from Feb of this year. Looking at the quarters as well, because they like to break down these numbers all sorts of different ways. They set a new quarterly volume record, 12.38 million contracts, up 38%. This is the first time I've ever seen anyone break out quarterly numbers. But the reason this is interesting is because, of course, next quarter we're going to start the introduction of the essentially 24 hours VIX Palooza, VIX Marathon, if you will, 24 hours of VIX futures trading. It'll be interesting to see how that rolls back into the numbers as well. So we've hit the low-hanging fruit of S&P implied volatility and all of the products therein, but of course there is a whole world of volatility out there that we like to explore, including the fixed income and interest rates land. And I know, Jared, you like to pay attention to that amongst the many products you pay attention to over there at Klineman. So what have you been seeing, particularly in some of the implied vol movements in some of the rates products over the past week?
Well, the story in rates implied vol for the last year really has been a pretty steady decline. There was a big spike across the board last spring when Fed LSAP reductions, the sort of tapering news broke, and it became kind of clear that the Fed was ready to change from targeting rates via quantity. Implied vol spiked. That's mostly been kind of burned off by now. What's been interesting to me over the last several weeks is that you've had a continued push lower, whether you're looking at short-term products like Eurodollars all the way out to long-dated treasuries. You just have implied vols kind of pushing ever lower. And that's even in spite of some of the big moves we've seen on a realized basis in some of these products. So, when Yellen spoke last, there was a big move in Eurodollars, but you didn't see any kind of corresponding change in implied vols in the product, even with shorter term options on those. So I think it's an interesting thing to know. The thing I've been thinking through is what this means for the year ahead as we think about Fed policy, and whether there's potential for a change in the volatility regime as we start to see, expect rates to tick up and expect the timeline for rates change to get ever closer. I think there's a few different ways to play that, but right now I'm focused on moves around short-term events because I think there is some potential, at least to own some gamma when you have events coming up that you anticipate with options priced so cheaply here.
Owning gamma, owning some juice, and doing stuff sounds like someone else I know here on this program, Andrew. I know Andrew. You're
about. Sorry, I don't want to talk over you. I don't know what you're talking about. That's all foreign gunk to me. I don't understand that.
It's quite literally Greek to you. Well, I know your favorite rates vol play of choice is out there in TLT. You guys been watching that at all over there at the pit lately, Andrew? And what do you think has been going on from a vol perspective out there over the past week?
One thing I thought that the 30-day gamma is just ridiculously cheap. You can buy an at-the-money straddle, 30 days to go to expiration for like $1.60. I think it was like 8.5% or something. I don't know, Jared, when you looked at it. I just looked at it today. We're doing one of our pro chats. TLT was just at 107 yesterday, I think. So they're all of a sudden they're saying, okay, well, the treasuries aren't going to move at all in a month. So I think I'm feeling like they overcooked it. I mean, back pre-2008 or even in the 90s, I mean, volatility of the treasuries was more like, the 7-8 handle. So ever since we've had this QE, government intervention, whatever you want to call it, it's jacked the vol up in bonds quite a bit. So I'm mindful of the fact that you can get that low, but I mean, 8% rib vol, I just count 8% volatility with 30 days to go to me is just gamma. And I think I don't think we're going to have too hard of a time seeing, a product like the TLT move, $1.50 in the next, 4 weeks. Could happen tomorrow. So it's not much.
Sounds like the Andrew Giovinazzi patented load up on some gamma and do some stuff trade for the next couple of weeks.
I think it's more like load up on some gamma and just close your eyes. Yeah, I don't know if you want to mess with it too much. Because why aren't we at, back to 107, 106? I mean, there's clearly something's gone on that, I mean, I know the whole world is short bonds because that's the trade. The Fed's going to have to raise rates and everybody was sure. But clearly we're not going down there. I mean, the crowded trade is everybody's long the TBT again. So there's so many people looking for bonds prices to collapse, and yet somehow they don't. So I think there is some room for volatility in there. Feels like there's still a potential squeeze, but ultimately, it looks like rates will be going down or will be going back up at some point. So I think there's a little more volatility in there, I think, than everybody's at least pricing right now.
Of course, that still leaves a very wide and broad universe of volatility products to explore. We have the commodities, the metals, the ags, pick your poison out here from a vol perspective. Of course, last week we had the big driver with that report coming out in the ags markets, really sending things like soybeans and corn on some serious moves. The question remains, is that vol kind of done now, or is there some more lurking out there in the hinterlands? Of course, we talked recently, Andrew, on the option block a week or two ago about size strangles going up in some of the nat gas products. Some people clearly thinking maybe there's some vol still left to run out there. Of course, the metals have had some interesting moves as a result of going into non-farms and what people are expecting the ECB and the Fed to potentially do. So there's a lot of potential grist for the mill there in a variety of products. So, Jared, I'll let you pick your poison. Where else is catching your eye from a vol perspective? Could be ags, could be metals, could be anywhere in the commodity landscape that really is attracting your attention right now.
In gold, we've seen that big move down in prices, and over the last 6 months, there's kind of these big swings either way. What's interesting to me is that the options market is taking that all in strides. You've got gold, if you look at implied vol in the futures, it's been relatively flat. I'm looking at like 3-month implied vols since the start of the year. Not much change despite some of the big swings. So that suggests to me, some traders making moves, but I may not see change in sentiment. We have been following that energy trade, especially in nat gas, and I think it is interesting how high prices have stayed after the run up this year. A lot of this was slated to be weather related, and I think people were targeting a move back down after we got some warmer spring weather. But yeah, you're obviously not seeing that. So I think that's still the big driver. But on the vol side, I think I don't see any particular edge there. Honestly, it looks like the options are fairly priced, and some of the big catalysts that were kind of pushing premiums in the first quarter this year aren't there anymore. So I think it's more of a trend question rather than a tradable vol.
And I know you like to watch the developing markets and the overseas markets as well, just for a variety of different drivers. It could be fundamental, it could be vol related. Anything catching your eye in any of your a variety of the products you have over there at Clinneman that track and monitor all these different markets? Any interesting volatility developments overseas really catching your eye right now?
I mean, it is notable that as people have swung back into emerging markets, the premium that built up in February is just totally gone now. So you have implied vol, like the EM ETF that everyone likes to watch, is that 1 month vol there was up in the low 30s, I believe in February this year. It's back down to around the low 20s now, just as quickly as it came up, it seems. As people have been, I mean, that's a flow issue. People have been, pushing right back into emerging market equities, and so the premiums have come right out. It's the same story in Brazil, where you've had big spike up. I think there's a little bit more edge there left in the options on the Brazil ETF, but it has been pretty remarkable. Just as soon as everyone, kind of put out a view that it was time to get out of emerging markets, people rushed back in, and the premium got sucked right back out. So it's been kind of a run from one side of the boat to the other.
And while you're talking here, I'm just looking at the chart for the India VIX over the past few years, seeing a bit of a surge over there, perhaps I should say a resurgence over there out in India VIX land. If you don't follow, that product is trading right around 22.5 right now in the cash. We saw it spike as high as nearly to 30, got into, I think, the 27, 28 handle range about middle of last year or so, then kind of came off pretty sharply. Opening this year, it was in the mid-teens, like a lot of other products, and right now gapping back up over into the low 20s range. We'll see how that holds up. But so far for this year, vol catching a bit of a bid out there in the India VIX, one of the few other international VIX products that has any sort of real volume or any sort of real interest behind it. So I like to pay some attention to that one. I know we've had some listeners write in the past asking us to compare and contrast the India VIX versus the big mothership, the US VIX. So it's worth throwing that one into the conversation. I'm going to do it for our volatility review segment. And now we're going to keep on rolling right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, and welcome to the volatility voicemail segment. And I think Andrew and Jared would agree this is also their favorite portions of the show, as well as mine, because it gives you guys a chance to join us here on the program, make your questions and comments and indeed concerns heard here on the show. All right, and first up here on the old volatility voicemail, we have a question from a listener who goes by the obscure handle of George. And he writes, big fan of the show, been listening for years. I think Jared is a great addition to the panel. Well, there you go, Jared. You have a fan. He goes on to say, there's lots of talk about HFT firms manipulating stock markets in the wake of Lewis's Flash Boys. I've seen lots of talk about price manipulation, but I keep coming back to all of your discussions on volatility views, and it makes me wonder, why is no one talking about volatility as it relates to HFT? Are these firms adding volatility to the marketplace? Could these firms be responsible for a lot of the vol that we see in the marketplace right now, particularly in very active names or in some of the volatility ETFs? Keep up the great show. Well, great question, George. I like to see that you're clearly a regular listener because you're talking about vol and all the other fun stuff that we like to hit on here on the show. And this actually is a very good question. It's a very timely question as well. Of course, the book you're referring to is Michael Lewis's new book, Flash Boys. He went on 60 Minutes, caused quite a stir, talking about how the markets are rigged against the little guy by these big firms that are spending hundreds of millions, if not more, to shave nanoseconds off of the round trip times of their trades and to get into trades faster than the average retail guy can. So it's causing quite a bit of consternation in the markets right now. The FBI, Justice Department, is sounding off. No smaller individual in the markets than Charles Schwab came out with a very big personal attack on HFT yesterday, which is kind of interesting considering what their core business is and how it relates to HFT and how it's an interesting side of the fence for him to be on from that perspective. So a lot of people diving into this fray from a lot of different angles. We'll table the is HFT evil and all that kind of stuff. That stuff comes up on a lot of other interesting areas. We, of course, listeners, if you want to know more about how all this stuff works, I encourage you to check out our Trading Tech Talk show. We just recorded an episode with Blair Hull, a pioneer, a legend in the world of options technology, and he has some very interesting comments about HFT in the options and stock markets and some interesting and very controversial statements I think you're going to want to hear. That show will actually be released when you hear Vol Views, I believe, or if not within a day or so. So stay tuned for that feed to hear more about his views on this stuff. We're going to stay away from that right now and kind of talk more about the structural and underlying mechanics of HFT and how it hits and impacts volatility in the marketplace. And it's a bit of a debate right now about what HFT, what the impact really is from a vol perspective. There are a bunch of individual studies. If you just search for high frequency trading and volatility, you'll find a lot of them. We have some of them linked on the Options Insider. There was a study, recent study called the Multi-Scale Model of High Frequency Trading, written by a few guys, one guy from the CFTC and some other people out of University of Illinois. They say one of their conclusions that in our stylized model, we show how HFT increases volatility, and they can quantify this effect and getting into some of the very, very in-depth granularity and minutia of their models and how they say HFT, at least in the equity markets, causes increased volatility, We've seen statements. You go onto the CFT website. They have a lot of research on this, and they have their own statements coming out and saying increased HFT activity causes lower short-term volatility in equities. We saw another study, I think, by Jonathan Brogard in 2012 about high-frequency trading and volatility. They determined that increased index volatility equaled increased active HFT. So it was more of the cart before the horse, where the increased vol brought these high-frequency traders into the product in an increased fashion, and that increased stock-specific volatility, not index, but stock-specific volatility, that actually reduced the active HFT, which makes sense. These guys want to flick in and out of quotes very quickly with a minimum of slippage. If you have a very volatile single name, that's probably not exactly conducive to doing that very effectively or in a very low risk manner. And of course, overall, they found that increased HFT reduced volatility. And then going back to the CFTC again, they came out with an interesting study towards the end of 2013 where they looked at a broad spectrum of futures products, because of course futures are the domain of the CFTC, and they looked at index futures, financial futures, ag futures, metals, you name it, a broad spectrum of products and how they were trading and how they were being impacted by HFT. And their conclusion was that HFT was not a driver of what they term structural volatility in those products, which means it isn't an inherent causal factor of the underlying volatility of those products. It may perhaps exacerbate it, which is something we can talk about here, but it isn't a fundamental driver. It's not going to create vol where none exists before that. So those are just some viewpoints on this. This is still very much a fluid area, as you might imagine, given the despite how important this topic is, there is still a relative paucity of research on this area. I know, Jared, you like to look at this stuff in a lot of different ways. First off, what's your take on this in general? Where do you come down on this debate? You think HFT, at least, let's keep it to equities for now. We can get into some other products if you want, but let's focus on equities. Do you think HFT in general is additive from a vol perspective? Does it reduce vol, or is it kind of a de minimis factor? It doesn't really have any impact.
I mean, I'm not an expert here. I can admit that, I think, safely. But I mean, I'm just skeptical a little bit of the whole just the volume of criticism kind of rushing in all at once. The timing of this from a media point of view, the fact that you get this book release, this dark pool exchange that's being promoted, and all these regulatory investigations all happening at once. Regardless of what my priors might have been, from a perception angle, it's a little bit suspicious and well timed. But in terms of the merits, look, I mean, I'm not the oldest trader out there, but I remember kind of when I first got started, and spreads were wider, commissions were higher, whether you're trading equities or options, and those were real costs, and those were with not high frequency; those were slow roller market makers and brokers. And these days, you can trade big volumes for a tiny fraction of a commission with penny-wide spreads. And I think a lot of that has to do with higher frequency people in the middle. So that looks like a real tangible benefit in my mind. Now, whether that exacerbates volatility when there's already some inherent movement in the markets, I think that's a really important question. I'm thinking back to the flash crash in 2010. A lot of people blamed high frequency liquidity providers pulling away from the markets for making things worse. And I'm not it's not my area of study, so I don't have any expertise there. But I think that's a worthwhile question to ask. But that's a totally separate question, by the way, from what's happening in terms of the public debate right now. Right now, we're just looking at this generic question of, does the little guy get hurt? And I think the answer there has to be no, because the people who are getting hurt, if anyone are large people sending really, really large orders who aren't typically retail traders. So, but yeah, I think that the question of whether high frequency trading provides a sense of, you could call it maybe false liquidity during a crisis, I think that is an interesting question.
You're right. That to me, not to get sidelined on this debate about is HFT evil or not, but that to me is always one of the more puzzling aspects of this debate, is how the little guy is getting hurt in all of this. You see Charles Schwab coming out on this. You see Michael Lewis coming out on this right now saying this is disenfranchising and front running the little guy. And yet I think there's a overwhelming preponderance of evidence that little guys are getting much better as executions as a result. If you're doing 10 lots, you're a happy guy right now, unless you're doing spreads, a little bit different. But you're right. It's the big 10,000 up institutional guys who are getting hurt by this. And that's kind of hard to argue that hurts the little guy unless you're talking about big fund execution on their 401ks and things. But that's a conversation for another day, for another show, in particular Trading Tech Talk. Check it out, listeners. Plug. But Andrew, where do you fall on this? Leaving aside is the HFT evil stuff, just the more fundamental impact that this type of activity has on options and indeed on volatility in general. Where do you fall on all that?
Well, I can give you a good story. Floor story. So, this is like mid 90s. We had the booming bull market and market maker on the SIBO. And I was one of those guys designated that if we had like people from the SEC or something come down on the floor, they would pop into a pit and I would talk to them, explain how the market worked. So this was before I would say they kind of before they actually had price time priority as a factor in the NASDAQ, where I was pointing to the screen, the Instinet screen, saying, okay, you see that market? It's a $0.50 wide in Microsoft, literally $0.50 wide, 1,000 shares up, what was posted in the OTC back then. So, and on Instinet, the market inside was, basically a quarter wide. And you could still see the prints going outside the market on Instinet, on the inner quote. So there was an inner quote and an outer quote. And I'm trying to explain to the SEC person, like, you see that? Somebody right there is buying it for an 1/8 and selling it at 3/8 all day long. I'm like, really? Yeah. She's like, how long has this been going on? Like, about 25 years. So that's how the market used to be, probably as late as 1997. And actually up until they actually enforced price time priority on the NASDAQ when everybody sort of woke up to this massive defrauding that was going on in the public. So just to give you some perspective, when you have to go buy Microsoft, you had to pay $0.50 a spread for Microsoft. And if I look right now, that spread's about a penny. So how did we get here? Who knows? The HFT guys, do they add liquidity or not liquidity? I don't think they're in the business of providing liquidity per se. I think they're in the business of leaning on orders, whether you do it electronically or not. And for those that don't understand what leading on an order is, say you have, and this was the big problem with pennyizing the New York Stock Exchanges, which really brought about the sale of the New York Stock Exchange, I think, is a specialist has an order to buy 100,000 shares at a limit. Okay. So and that limit, let's say, is $50. So in the old days, if you want to lean on that order, which basically means I will bid in front of the order because I know the most I can lose is an 1/8 because I got this giant order right behind me that I could go sell. So, you only had an 1/8 loss, but when they went to pennies, you can now stand in front of that giant order for 1 penny. Instead of having to take 12.5 cents of risk, you only have to take a penny worth of risk. So you can get long at a penny in front. And if the market starts to go the other way, you're selling it out. Okay, that's how market making works in general, right? There's just buyers and sellers kind of leaning on every order that's sort of posted in the book. So what you have with HFT is that's kind of happening very, very fast and in sort of, micro dimes and micro pennies and however tiny increments that the exchanges let them get away with. My only problem with it is what really constitutes an order? Because like in the old days, you'd say I have an order and I have to order by 100 shares, or I'd say 100 contracts at a price, and my order takes precedence right now. So what means is that order has to get filled for the customer, that what we'll call retail customer paper. Could be a hedge fund or anybody, but still non-professional paper in the old days. And that order would have to get filled first at that price. And I think part of the problem is now is that order can be separated into kind of bites and it kind of floats around to different places. And I think that's the problem that this guy had when he wrote the book. So all of a sudden, an order really isn't an order anymore because it's getting filled on multiple exchanges instead of getting filled on one exchange. And that's probably, and really the problem with this now is price time priority. Is price time priority being violated? Well, when the first order gets filled, right, then they still got a bunch more orders to get filled. Technically, it's not being violated because just the other guy basically has a faster electronic broker than the original paper that hit the floor. And now, if this sounds overly complicated, that's kind of where the rub is. I don't think it's illegal. It's just technology has got to the fact that you have essentially a very fast executing broker. And that speed is in, whatever a nanosecond that you want to come up with. But like Jared said, what's the end result? You've got markets in the SPY are a penny wide. Can't do much better than a penny. The whole point of all of this pennyizing and decimalization, all this was for the end user to get a decent fill, right? To get they see a penny wide market, they get a fill. What does it take to get that penny wide market? I don't think anybody, and clearly, this guy was in the market, Michael Lewis, he's been around for a little bit. He's got some idea what market making is. What does it take to generate that penny wide market? What are the salient factors that go into generating tighter markets? I think that the HFT, since they're here and we have those markets, they probably contribute to some degree. So do they add huge liquidity? I guess we'll find out one day when they're gone. There's a lot of unintended consequences to any time you mess with a financial market, as we well know after 2008. So I don't think it makes that big of a deal. I think they're going to have to change what they actually define as an order. And once they do that, then they'll probably be on the proper path. Because as far as it looks like right now, it's just the HFT guys have a faster broker, essentially, than everybody else, as far as I can tell. So does it make the market more volatile? We've 80 volatility in the crash. Right? In 2008, there was 120 volatility in the VIX in 1987. We've hit those numbers twice. Can you blame HFT for either of those? Not really. Just mostly, financial, whatever, all the problems that go into making a market crash had nothing to do with, high frequency trading. Just nobody wanted to buy anything and the bid can go way, way down. So I don't think it really does much to the volatility, realistically. Again, that's my opinion, and that's just making markets for a long time and seeing what the real effect of that is on people. So, and that's where we are.
Yeah, this is a great question, George. I think obviously we can go back and forth on it for quite some time. I think right now the moral of the story is that there really isn't a firm answer on yes or no. Do they add volatility? You heard from Jared, you heard from Andrew. I tend to fall on the side of kind of where the CFTC falls a bit as well, that they don't really add structural volatility, but they could exacerbate it. And I think that's why the part of your question that asks about the vol of vol is spot on. I think that's where these guys could come in and exacerbate a movement in volatility that we're already seeing. Jared touched on the flash crash. It's obviously an extreme example of that, but a lot of these times where we see some dramatic movements in volatility, some of these HFT players could be at work. So interesting question, George. I think there's a lot more discussion to be had on this realm in the coming weeks and months as this HFT debate unfolds in a lot of interesting directions. So I think we'll be coming back to this again down the road on the show. Maybe we'll bring in some more guests who can dive into that specific area of the volatility space as well. But great question. We're going to keep an eye on this. I think that's pretty much all we can say right now. As we move on to our next question from Evo16, he writes, I'm a regular user of VXX. Well, I'm sorry for you, Evo. No, I'm just kidding. He goes on to write, I've heard you refer repeatedly to the cost of rolling this product and how it negatively impacts holders. Is there anything I, as a regular VXX owner, can do to minimize this? Are there other ETFs out there that attempt to do this? Well, Mr. Evo 16, this is an interesting question. You're, of course, referring to the roll risk, also known as the roll yield, euphemistically referred to as roll yield by a lot of these providers of these ETFs, even though that yield is actually negative in most scenarios. And we've talked before about your specific product, VXX, depending on the numbers, depending on the month, depending on the term structure of the VIX futures, can lose anywhere from 5 to like 15% a month based on that negative roll yield. So it's a substantial cost. If you're losing that every month and you're a buy and hold guy in VXX, you're going to underperform. Now, there are some interesting alternatives to that. And it's an interesting problem. Obviously, it's top of mind for a lot of these ETF and ETP creators because this is costing them business. This is costing them returns. Right now, there really isn't one magic bullet solution to this. People are taking a bunch of different approaches. Some people are, because what we're talking about here, quite frankly, is, of course, the selling of the very, very cheap near-term vol and buying more expensive vol somewhere out in the curve. Could be mid-curve, could be farther out, wherever the product you're looking at structures their roles. And people are trying to fix this in a variety of different ways. Some people are taking an approach of more of a basket of futures throughout the entire term structure. So some in the near term, some in the mid curve, some in the farther off, and hoping that that averages out some of the negative roll yield and makes it a little bit less painful. Other people are taking a more they call it dynamic. There's that dynamic ETN from, I believe, iShares. Other people are calling them optimum yield products, taking a more active management type role where they're actually doing what we talk about here on this show. They're looking at that VIX futures term structure, and instead of saying every 2 weeks we're going to buy the 2 month out future and sell the front month future, they're going to do it more dynamically and look at where that curve is cheapest, where it's more expensive, and then buy and sell accordingly. Now, of course, your results are going to vary depending on the skills and nuances of those managers and how well they implement that. But if you find a decent manager and a decent firm, that might actually go a long way towards mitigating that roll risk. But right now, as a VXX owner, either switching into the futures or switching into perhaps one of these dynamic or optimum yield type ETPs and getting the heck out of VXX, that's pretty much your best alternative. If you still want to stay in the ETP realm, if you don't want to get into the futures, if you don't want to do some of the other strategies we've outlined on this show, then probably your best bet is one of these type role management products. I haven't reviewed all of them to see which one is the best in terms of return, but that's probably where your best bet lies. Jared, what's your take on this? Obviously, this is a very, very important issue for a lot of people out there. A lot of people still, for whatever reason, maybe they don't listen to this show, still buying and holding VXX, and they're getting clobbered as a result. What would you say here for our friend Evo 16?
Yeah, I think there's a conceptual or a linguistic clarification we can make right off the top, which is to say that, so people describe this this feature, this behavior in VXX as a problem, and I would say that the roll cost of VXX is a problem, like the time value of money is a problem. It would be nice if you could make an investment that didn't depend on the time value of money, but that's just a fundamental feature of the market and the world, that time passes and it costs to get financing for something. And I think that's exactly the kind of relationship that's at work here. If you think of just a basic option contract, we all know that it's going to decay over time as that expiration date gets closer. And that's really all that's happening, I think, ultimately in these VIX futures ETPs, that as the nearest contracts get closer to expiration, and you sell those and buy longer dated contracts, you're moving further out in time. You can see the same kind of dynamic at work in fixed income markets or anything that has an expiration date attached to it. So all the angst about VXX, I think, is pretty misplaced if it's just a frustration with the fact that there's a time value to money. And I think that sometimes, at least with some customers, maybe they don't have a lot of experience in the options market, and so that maybe there's some of the surprise is just based on the fact that they're not thinking about this in terms of an option play. If you were to imagine, instead of buying VXX or buying some other ETP, would you go out and buy a front month put or a front month call and then in size, and then sort of gradually roll those into second month puts and calls every single day? If you did that, you'd incur the same kind of cost dynamic. But I think that because those option contracts have that that expiration date attached. But really, that's all that's happening in the case of these ETPs. And I think once that part is clear, then it looks less like a problem and more like just a characteristic, let's say, of the product. And you can approach it, I think, more neutrally in that vein. And in terms of the other, the different ETPs in mind that reflect this fact, I've been a little bit skeptical, though some of them have pretty mixed performance so far, just because I think they try to take a commit to some kind of a rule set about the nature and the relationship among different points along the VIX futures curve. And I'm not convinced yet that that there's any kind of stable stable dynamic among different points of the curve. I think that the flow in the market dominates that a lot of times. I think that different economic regimes, just underlying what's happening in the economy and the market, dominates that a lot of times. So any kind of structured ETP that tries to play that relationship, I think is going to fail if it doesn't have more flexibility than the ones we've seen so far. I think ultimately traders can do best by either trading the futures themselves, doing equivalent plays with options, or trading some of the ETPs against one another.
That's obviously the big challenge of that is you want a product with some sort of structured rule set, and yet the second you do that with the VIX term structure, you're killing yourself because you have to be flexible with that. You have to roll, pun intended, with what's going on out there. When the mid curve spikes, when the far off curve spikes, you have to be able to adjust. And if you have some sort of, you're right, some exact time structure for when you roll, that's not going to work. So then you're putting a lot of faith in the people who put these ETPs together to be able to spot the right opportunities and exploit them correctly, which again is another problem. That ETN I was referring to earlier, the iPath Dynamic VIX ETN, ticker symbol XVZ, trading right around 31 right now, only did about 52,000 shares today. So not exactly a world beater from a volume perspective. So you may have other problems with that name in terms of bid-ask spreads and such when you're looking at those. But you're right. This is a very, very, very tricky problem and an interesting one for a lot of our listeners. Andrew, where do you fall on this? Obviously, this is a question we receive some variation of almost every week. How do I keep myself from getting hosed in VXX? I know what your knee-jerk answer is going to be. It's going to be get the hell out of VXX. But in lieu of that, what else would you have to say here for our friend Evo16?
What we've done actually is we've come up with a time spread structure for it. Depends on what his needs are, but that's some of the thing we teach at Option Pit is how to get the position you want with, for a particular product. So VXX has a lot of very interesting characteristics. And I think what the person has to ask is, what do they want out of VXX? Do they just want long volatility exposure? It has decay, but it also has a very volatile Vega component to it when you buy, let's say, 3-month options and like that. So, you can buy, essentially what you can do is you can kind of buy, think of it, you buy a strangle, and then you could sell a near-term call against it, which basically would give you a short delta for VXX, but also gives you a lot of long Vega. So what normally happens when the market does, when like say the VIX starts to pop, volatility in the vol products goes up, 30, 40%. I mean, you're going from like a 40 vol to a 70 vol or a 65 vol. It's a huge move. So you kind of bank on that's going to happen, and you also get to play the decay. So, it's what it is it's education and structure. So I can pretty much create a position for almost any scenario given a set of circumstances. So you have to know how the product works. And that's, like I said, I like the VXX because it's reliably crappy, the UVXY, all those, there's about 6 products I look at all the time, and I just forget about all the rest of them because I think they all don't really work very well. So you have to educate yourself on what's the position you want. So if you're just going to say, I want to buy volatility, but I don't want to pay the decay, you're going to have a tough road to hoe. However, you can structure an option position to at least minimize or negate the decay and still end up with a long Vega position, which is what you want anyway in the first place. So, I gave you a hint on how to do that, but Normally that's, what we charge people lots of money for. Actually, not lots of money, but some money to teach them how to do that right.
There you go, Evo 16. A little bit of a tip, but if you want the full meal, then you have to surf on over to Option Pit and check out their classes. Great questions from all of you guys out there. I know a lot of email, a lot of questions pouring in. Keep them coming. We get to as many as we can every week, but now we have to keep on rolling right on into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, and welcome to the Crystal Ball segment. This is, of course, the portion of the show where we tell you what we're watching, what we're keeping an eye on from a volatility perspective, and perhaps what we're expecting for the coming week from a vol perspective. We'll kick things off with you, Jared. What are you looking at? What are you watching? What are you anticipating for the coming week from a volatility perspective?
So, I got out of a lot of short Vegas stuff over the last 2 or 3 weeks. Not for any good reason, just because trader positioning wasn't doing what I expected to, and when I feel like I don't know what's going on, I prefer to get out of the way a little bit. But we did have some short gamma stuff in April and May. Today was kind of perfect for our net positioning. We were short some upside, call gamma in the S&P. So obviously a big sell-off relieved that pressure. But with the market still in terms of realized 1 month vol around 10%. This move up in bids today for premium, I think, is probably sellable. There's some talk every year about this time around how much people need to sell to sort of pay their tax bill, which sounds kind of trite, but I think historically it's actually been an interesting thing to look at. When you have a big year prior, people see what their bill is going to be on those gains, and they say, maybe I should sell some of these junky biotech names that aren't doing much for me anyway, to raise cash, stuff like that. I don't know what if there's a better explanation for the sell-off today than that. I'm not usually a big fan of explanations, but I think that this kind of move is sellable from a volatility trader's perspective, and so I'm really sort of ready to get into some short vol stuff, more looking at May, June, July than anything closer term. After we finally got a pop today.
Take advantage of the tax pop to finance your own taxes for next year there, Jared. I like it. Good plan. All right. And Mr. Andrew, what are you watching for the rest of this week, sir? And what is on your radar from a vol perspective here?
Vol perspective, like the two key ones for me are Treasury vol and the vol product volatility. I think the name volatility, like the momentum name volatility from a gamma point of view, has been cheap for the last week. We had some decent looking trades in those. But just watching to see if this is actually the low, or we actually set new lows in this. Because if we set new long-term lows in the volatility of the vol products, that just means that really that big risk paper is not so worried about what's going on in the future anymore. The structural issues seem to go away, and it's more like kind of short-term, blip and blop of the market, and not so much, are we going to zero again? So I think that's and when those type of things happen, that's a big deal.
All right. Thank you, Andrew. And unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, let's check in really quickly once again with each of my cohorts here on the old Volatility Views panel to see what they have cooking that may interest you, at least until the next time we all gather together around the old Volatility Views panel. Starting with you, Jared, what do you have cooking up over there in the land of Condor Options and Klineman Financial Group that may interest our many listeners?
I've got a note for our volatility tracker research clients coming out next week, looking at some longer term views on what's happening in interest rate volatility. We've been watching realized correlation in equity sectors for a while now, and I'm updating work on that as well. And one other thing, there's been a lot of talk in the media this week. SocGen put out a note noting the fact that a lot of hedge funds and speculative traders had moved out of their VIX positioning. We kind of have been on this trend for, I don't know, since early February, really, since way before it was in any press. So it's a little claim to fame there, just kind of being on trends in the early stages before they get a lot of attention. And that's what I'm trying to do next week too, is to stay on top of things that aren't big stories yet. We're managing accounts to the best of our ability at Klineman and doing just fine in that regard. So both of those things I think are worth checking out.
There you go, listeners. I believe it was George, or was it Evo16, who wanted to know how to manage his roll yield. We'll call up Jared. He'll manage it for you. There you go. And if you want to find what he's talking about there, that volatility tracker, and surf on over to condoroptions.com/volatility tracker, and you can get access there and subscribe and check out the recent issues and what he's been working on over there. All right, and last but certainly not least, Mr. Rock Lobster, what are you cooking up in the land of the pit?
Well, let's see. Besides those succulent and tasty lobsters, we have our new gold course again, which is available to helps you answer some of those questions about how do you finance the roll yield. Well, it's just a theta problem, and as soon as you figure out how much theta you have to pay for, you can construct a position to do it. So that's the idea of our gold course. Also, we'll be rolling out our chat soon. Basic to let people, talk to either Mark or I or some of our other pro traders as kind of an open way to ask questions, talk about position structure, and just plain old thinking, are these ideas crazy or good? So those are the new gold courses out. The chat will be out soon. And as a parting shot, I think given the move in the market today, I think the move in VIX is kind of undercooked, at least at 306. So it'll be very interesting to see if any of this continues into Monday. Right now, I don't think it will, but we'll see.
All right. Thank you, Andrew. And that is, unfortunately, all the time we have for this episode of Volatility Views. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them coming. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatility views. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.